Good afternoon, everyone. Thank you for joining me for the webinar today. I thought the news might spark some interest, so we thought we'd spend a little bit of time talking about what's going on in the markets right now and how it might affect the portfolio. Appreciate the opportunity to talk with you. I'm hoping to spend about 30 minutes discussing some of the elements of what's been going on in the market, this invasion of Russia and Ukraine, the market reaction, and how it might impact our portfolio and what we might do. So this is just an opportunity for us to spend some time on that. And we've got about 27 minutes to go over that today. So first thing is, I just will tell you, we are not concerned, really not in any way at all. There are obviously geopolitical implications that could be a whole lot worse than what's going on in the stock market. But as far as the global economy and the market in general, we feel pretty confident about it. So I think the few slides that you'll see here should reinforce why we feel that way. But that's kind of the bottom line. So, so you didn't want to sit for the whole thing. That's the bottom line. You've gotten a head start on the end of the presentation. But we'll be going through this a little bit piece by piece and kind of showing what's going on. First thing, just a few disclosures that we always show at the beginning of these presentations. And the very next thing is, the big question is, should we be afraid of the current stock market correction? And in our response, we would say we've been anticipating this for some time, and there's some very good reasons. For those of you who have been in your reviews already this year, you've seen the results from 2021. And of course, you already know the results from 2019 and 2020. And you'll recognize this little snip as just a part of what we present when we present the asset class returns in your portfolio. You can see what's happened over the last 3 years just in the US market. This large cap indicator here is the S&P 500. And the S&P 500 has been up remarkably over the last 3 years. 2019 was a great year. It was up 31% for the year. You may remember in 2020, that's when the pandemic started, it dropped 30+% and then rebounded to end up positive over 18%. So a massive swing, almost a 50% swing from negative to positive in 2020. And then it continued to march on in 2021 with the economic stimulus that the Biden administration put into the plan. And ultimately, what ended up happening was the market closed out up 28%. So we've just seen some, maybe not unprecedented returns, but just some really absolutely remarkable returns in the U.S. stock market over the last few years. And so this tees us up, if you will, for additional volatility and potentially a correction. So not unusual for us to see this type of volatility after growth like this. And we saw it really right out of the gate from the beginning of the year. So this is where we are right now. We've just essentially entered what we would call correction territory. So for us, a correction is a 10% decline point to point. That kind of defines the term correction. So it's anything really beyond 10%. So if it falls even further than 10%, then that we consider that a correction. But 10% is that threshold. We crossed into that territory in February 22nd, so fell through that. And we're starting to see an expansion, if you will, of that this morning. But we saw essentially a steady slide right from the beginning of the year. Declines right off the bat, a little bit of a recovery, another steep decline right through the end of January. And during this time frame in late January, it actually touched 10% intraday, but then recovered. And then we saw a bit of a recovery. So some optimism here, got up to about -4 or so. And then now it's kind of teetered around, jumped back and forth. And now it's fallen down below 10%. Now, this was actually earlier today. And no way to know how the market's going to react to anything. But we've been saying since middle of last year that it was time for a correction. If you've met with me in the last 6 months, you've heard me say that, brace for a correction, because with that much growth in the prior 3 years, valuations are higher and corrections are essentially imminent. And so, that's not a surprise to us. But so, of course, when Russia invades Ukraine, then the market has a knee-jerk reaction to that and essentially kind of prepares and sells off, and then people jump back into the market because they're seeing valuations are a little less expensive. And as a result, we see a bit of a dynamic here that we start to see the markets moving around a little bit. And so, so now the market has actually recovered a bit intraday. So it started out the day down about 2.5% and has recovered. I didn't look at it in the last 5 or 10 minutes, but the last time I looked at it, it was only down not even quite 1%. So it's down still below that correction territory. So we're down below 10%. So we still are in, full-blown correction territory for the year, but not in the 13, 14% range that we were approaching earlier in the day. Recovered a little bit from that. Doesn't mean we won't be, but it does mean that for the moment we're not there, and don't really expect to see that today. It looks like it's probably going to recover a little bit today and end up not too bad, but we'll see how that plays out. So to reinforce the reason that we're not concerned, for those of you who've been on these webinars before, you've probably seen this slide before. And the slide is essentially just yearly returns dating back into the early 80s. And you can see the yearly returns. You see the yearly negative returns below the line here. And then the dots represent the intra-year declines that occurred inside that year in spite of what happened at the end of the year. So in other words, if you look at the most recent years, down here in the early teens, for example, this year was down a 10% decline, and the year actually ended up 13. And the following year, the market was up 30, but it had a 6% intra-year decline. And this year it was up 11, and it had a 7% intra-year decline. This year was only down 1. But it had a 12% intra-year decline. So the point about this is that if you look across the spectrum, every single year has some type of intra-year decline. And what's remarkable about this, dating back 40 plus years, that intra-year decline average is 14%. So so someone asked me actually not too long ago, and I chuckled a little bit when she said this, but she said, "Is it your faith that gives you such confidence in times like these?" I thought that was a nice compliment. And I said, of course, my faith has some to do with it, but a lot of it is that I just know the numbers. And the numbers say that on any given year, if you're not expecting a 14% intra-year decline, then you're expecting something better than average. And all that means is that the market can be down, somewhat significantly. I mean, here's a 16% intra-year decline, and it was up 13. Here's a 28% intra-year decline, and the market was up 23. So the reason we don't really get too worked up about intra-year declines is because they don't mean a whole lot in terms of what the outlook for the economy is, what the outlook for the market, even for that given year. Those intra-year declines really don't mean a whole lot. And so I can assure you that in every single one of those cases, in every single one of those declines, there was something going on that compelled the market to get nervous and ultimately to decide to sell down the market at that point. And so that's not unusual. And I wish I had a nickel for every time I heard someone say, well, this time it's different. And it is different every time. And that's what makes it a whole lot the same. So those intra-year declines don't really cause us concern from a broader economic perspective because they happen all the time. And the average over that period is 14%. So so not a whole lot to get worked up about there. And also, if you get right down to it, we haven't seen a 10% decline in well over 2 years. So now we're in a situation where we date back to February of 20 to get a 10% plus decline. And that's just not really normal. If the average is 14 and you look at all these intra-year declines, it's not normal for it to not go down intra-year at a pretty good clip. And so what we do is we try to make sure that we're keeping that perspective in mind when we're looking at the market. And when it goes down, we just don't panic because frankly, that's just what it does. That is just really over time. That's just what it does. Get good returns for a few years, and then you get a little bit of a correction, and then you get good returns again the following years. And that, again, we reinforce that in our most recent meetings, but you can look over the last, say 10 years, and you had a year here that was 0, and then 3 positives and a negative, 2 positives and negative, 3 positives, maybe a negative this year, no way to know. But it's not unusual. That's the whole bottom line point. It's just kind of the way the market normally works. So I want to put in perspective really what's been going on in terms of the movement of the stock market and the S&P 500. And whenever we say the stock market, we're really specifically talking about the S&P 500 because that's what most people will kind of track. And what has happened is that we've seen a little bit of pricing disparity, if you will, in the US stock market on the technology companies versus companies that are kind of the normal other companies in the S&P 500. So the first thing to note is that what we call mega caps, so very, very large companies, mega cap companies, that the stocks, the top 7 stocks of those, 7 of the top 10 of those stocks are mega cap technology companies, 7 of the top 10 stocks in the S&P 500. And they amount to a total weight in the US stock market of 24%. So it's a substantial portion of the US stock market. So right now, what we're really experiencing is a swing of those mega cap companies. So in spite of the fact that, the market is down just over 10%, these FANG stocks that have changed their name, so we've got to have another acronym, but you're talking about Facebook, Apple, Amazon, Netflix, Alphabet, or Google, they're down right now in total about 21%. And that's because they tend to be high-flying technology companies that have more volatility whenever the market sells off because their valuations are a lot higher. And what I mean by that is if you look here in this box, the top 10 stocks of the S&P 500, which include those top 7 stocks, of course, the current forward price to earnings ratio is 33.2. The average of those same top 10 is only 19.8. So those stocks right now are trading at 160%, 168% of their average, which just means those valuations are, really high. And we've been talking about that for some time. With all of the stimulus money that's come into the US, those stocks really took off. You can see this spike in valuations here that occurred just within the last couple of years. Spike in valuations, quite a lot of disparity between the rest of the stock market and these technology companies. And so as a result, that 24% is really, that 24% of the total is really pushing the prices down because now they're pulling 21% of the return negative here for those stocks, pulling the rest of the S&P 500 down. And so we're kind of seeing that. If you have a regular market cap weighting and you own the S&P 500, which we do, then you're really kind of seeing a lot of that pull just from those technology companies, but you have a little better balance too. So a lot of this decline is going to show up in the growth stock funds, but because we have a more equally balanced portfolio, we're not catching the brunt of that growth stock decline. And so essentially right now, what we're seeing is the remaining stocks only have 19 times earnings, and that's only 126% of the average. So that puts the S&P 500 at 129% of the average. Now this is a little bit dated because this S&P 500, I'll show you in a second, the forward PE is actually down even below that as of today. So I'll show you what I mean by that in just a second. But these stocks have now become a much larger percentage. That's what this graph is showing, a much larger percentage of the total. And so when you look, historically, those stocks have been, back in the 2000s, that's when the dot-coms were really going. Those technology companies became a big percentage of the total. The top 10 stocks then declined and only resulted in about 16% down here in 15, 16. And now they're almost 30.5% of the total here. So those top 10 stocks are really having an outsized influence. And those stock values have grown a lot over the last few years. And that's where a lot of that's coming from. So I'll show you another reason that we're not especially concerned about the outlook of the future. And that is basically because when you look at current valuations essentially tell you how well you are expected to do in the future. So the lower the current valuations, the higher the future returns are expected to be. And it's real simple. And you've heard me use this illustration before, but it's like investing in investment real estate. You know, the pros will tell you don't make money in real estate when you sell it. You make money in real estate when you buy it. And what they're saying is that if you buy a piece of property at a deal, you know, at a discount, and you're able to hold it and get the fair value, then you get a much higher return than if you buy a piece of real estate at the top of the market. And so basically what we're talking about here is the same thing. The S&P 500, as it declines in value, it increases our upside potential. And right now, the S&P 500 is actually trading at 19 times earnings as of February 22nd. So 19 times earnings, which is only 116% of its value. And so, you know, you could still say, wow, you know, 116% is still overvalued, and we wouldn't argue that at all. But if you track it back a few years, we're almost, you know, right on practically to the number where valuations were back at the beginning of 2020, this time in 2020. So we've backed up in terms of valuations 2 years. It doesn't mean we've lost that much money in the market. What that means is that the earnings of the companies, as they continue to grow, now the earnings have grown, and now the stock prices have come down a little bit, and that results in a ratio, a PE ratio, that is price to earnings ratio that looks more palatable in terms of future returns. And so we've seen the earnings grow, and now the prices have come down. So now the valuations are actually less than they were 2 years ago. And you know what's happened in the last 2 years. So we don't expect double-digit returns, but it does mean that the forward returns are likely to be a little bit better than the potential was, you know, before we got a correction. It just gives us the opportunity to buy in. And the other thing about that you have to remember, and as a reminder, I had someone mention to me the other day, they were kind of watching the Dow, and they said, well, you know, we backed up to this stage, and that means that we really haven't made any money over the last couple of years. And I said, well, hang on just a second, because that's the whole point of rebalancing. Whenever the market's going up, the idea is it's like being at a poker table. You know, when you're winning, you want to take a few of those chips off the table and put them in your pocket, because it's easy for that table to turn on you. And the stock market is the same way as we go through our systematic rebalancing. So the systematic rebalancing process is selling those things that have gone up too much, if you will, selling them off and putting them in our safe bond portfolio and parking them there until we see the market decline again. And so we go through that process. So while if you look at the numbers there, the I'm sorry. If you'll check your phones and just make sure that you're muted. I'm sorry about that. It's supposed to be muted. Let me see here. All right, let's see if that helps. Okay, yep. Thank you for just reconfirming that your phones are on mute. I'm not sure how that one worked. I muted everyone from the beginning, so I'm not sure how that happened, but in any case, sorry about that. So just looking out forward, the idea is that the potential going forward is better than it was, just because we've seen some market declines and the averages are a little better now than they were before. Okay, so here's the big question. How am I supposed to process something like Russia, you know, one of the largest countries in the world, invading Ukraine? What does that mean for our stock market performance in the future? And this is a very interesting chart that was prepared by one of our research partners. It comes from Bill Stone, who's the Chief Investment Officer of Glenview Trust. And I thought this was a really fantastic resource. It's a little bit small here, but I'll walk through what this actually means. So the point of the chart is to share that the stock markets tend to recover quickly after geopolitical events around the world. And so while the short term might be a little uncomfortable, because the market tends to have a knee-jerk reaction to anything that is a surprise or any negative, the longer term perspective, and I don't mean years, I usually mean weeks or months, the longer term perspective is still really quite positive. So if we walk down this list, many of us are old enough to remember some of these time frames. But what's interesting is to see what has happened in the stock market immediately following these, what you might call crises over the history of the market dating back to the 1940s. So looking back over the 1940s, you might say World War II had to be one of the most dramatic events in that period. So Germany invades France in World War II in May of 1940. And so what happened after that? Well, of course, the stock market declined in those early years. In that early period, first week and month and so forth, recovered a little bit within the 6-month period, was down about 22%. So that's probably the worst example on the chart. So that's a big thing. Pearl Harbor, of course, that's interesting. Within a year after Pearl Harbor, the stock market was actually positive. You look at the Korean War, it only took 3 months after the start of the Korean War for the stock market to recover after the weekly declines. Suez Canal turned out to be kind of a bad market, but that was likely just a period in the economy. So that's down 11. Here's the Cuban Missile Crisis, up 24% within the first 6 months. JFK's assassination, 12% in the first 6 months. Go on down here. So some that are a little bit more recent. But you look at U.S. invaded Grenada. So the initial reaction was negative. The 6-month reaction was negative, but then it was positive after a year. The Gulf War, for example, the stock market was really good during that period. So it was actually up 32% within the year. It was positive most of the time frame through there. World Trade Center bombing, same thing. U.S. coal bombing, this one was kind of negative. That was actually during the end of the dot-com bust. So 2000 was a bad year in general. Same with 2001 and 2. So really had very little to do with what was going on in the geopolitical circumstances. It was really an overpriced stock market that was trying to get back to normal. But even 2002, after the Bali nightclub bombing, it was up 25%. So you see what's going on here is that the initial reaction is almost always negative. So as people try to process the implications, and you'll hear in the news, just to kind of reassure you, you're going to hear them talk about inflation. You're going to hear them talk about the U.S. involvement. You'll hear about gas prices going up. You always hear that statistic. It's the highest gas prices have been since 2014, I think is the last thing I heard. You're going to hear all of that because that's just part of the fear-mongering media. But the fact of the matter is, when you look at the stock market, it tends to not react that way. It tends to react more rationally given enough time. And that's what, if you've never learned anything about the stock market in the time that you've been invested, that's one of the most important things that you have to realize is in short periods of time, a day, a week, a month, a quarter, even a 6-month period, you might find the market reacting very, very emotionally. Once you get past about a year, 2 years, 3 years, the market starts to look far more rational, and it really is built on earnings growth, valuations, economic outlook, et cetera, interest rates. You look at those components, and all of a sudden it starts to really make sense over a longer period of time. The market does not make sense on a short period of time. You can't judge good or bad on a week, month, quarter, for the simple reason that the market doesn't react rationally in those periods of time because it's driven by irrational fears and greed. So we're all built that way. And if we become fearful, we tend to sell our portfolios. If we're greedy, we tend to try to add to the portfolios. But that doesn't really fundamentally define what's going on inside the market. What defines what's going on inside the market is how well are the companies doing? Are they making great earnings? Are the earnings growing? Are the stock prices reflective of their potential, et cetera, et cetera? And all that washes out over a long enough period of time. And so what does that mean? Well, if we look at the averages of all of these, I think there are 26 of these, so 29 different events. The average is the first week is a negative reaction, down on average 1%. The first month is a negative reaction, on average about 0.5%. After 3 months, it averages 1.8. After 6 months, 4.8. After 1 year, 12.3. So, this is an average of 29 events. Does that mean that's going to describe what's happening happening in our event? Not necessarily. I mean, the stock market's already high. We've been telling you that it would correct. It had to correct eventually. If it dropped, down 15%, we wouldn't be 1 ounce surprised, because it's been so good for 3 straight years, and it tends to come back after that time frame. So if it should decline, we wouldn't be surprised. If the decline lasted for the rest of the year, I still wouldn't be surprised, because that's what it does. But the fact of the matter is that geopolitical events, which on the surface seem really catastrophic at times, do not necessarily translate into an outright negative stock market. Sometimes the market moves in exactly the opposite direction that you would think, and you have to be ready for that possibility, which is the very reason that we see, over 130,000 troops lined up at the Ukrainian border. I think everybody on the planet thought that they would invade. I mean, we were hoping not, but we really thought they would. So why don't you get out of the market? Well, the fact of the matter is sometimes the market doesn't care. At least in the short term, it might care a little bit, but you get out a month and it doesn't care. And so your timing might be really bad and you miss growth opportunities. So that's why we ride it through. So the question is, what do you do in those periods of time when you have a stock market that is not behaving? And this is our checklist. So these are the things, this is how you win, how you beat the individual investor because you're smarter than the individual investor, and how you essentially make lemonade out of lemons during volatile markets. And the first thing is, of course, is if you have IRAs and you should consider a Roth conversion. Roth conversions give you the opportunity to move assets from a taxable environment to a tax-free environment. And if the market drops 10 or 15%, say, for example, you do a conversion from your IRA to your Roth IRA, you're down 15%. And when it comes back, which it always does, it comes back to 15%. Instead of coming back in a taxable environment, you come back in a tax-free environment. And now all of a sudden you've got all this tax-free growth built into your portfolio. So, we're always analyzing for Roth conversion opportunities. As the market really declines, we recommend delaying large withdrawals. So if your car is still running and you were thinking about buying a new one, a good idea not to buy one after a 15% correction, because you don't want to be in a position where you're pulling money out as the market is decreasing the values, because you're just taking a larger percentage out. Give it a little while to come back. If you can postpone the car purchase or the RV purchase, postpone it for a month or so and just kind of see if the market recovers. That's a much better option than taking money out while the market's in a decline position. Another one, if you're taking monthly income, we say, postpone your monthly income. Just turn it off for a little bit. If you have to use your home equity line to kind of supplement, that works okay. But if the market declines, say 15% or more, that's a good time to turn that monthly income off. And the reason for that, of course, is if you're taking out, say, for example, your 4% withdrawal or 3% withdrawal, and the market declines 15%, well, you're not taking out 4% anymore. You may be taking out closer to 5%. And that puts a dent in your portfolio. By just postponing these monthly withdrawals during periods of severe declines, you increase your ability to take more money out of your portfolio over the life of your portfolio, and it increases it by 20 or 25%. So it's just a little quick play. You just take a temporary postponement on that, and pull money from savings or use the home equity line if you have to do that. If you have money sitting on the side that you've been kind of trickling in the market, we're always watching for this opportunity. So we say accelerate that dollar cost averaging during periods of decline. So we'll be looking at that as a possibility for some of our clients who are trickling money into the market right now. Watch for opportunities to opportunistically rebalance. We don't expect you to do this, but this is something that we do. We're constantly analyzing the portfolio on a daily basis to see if one asset class has fallen further than another. And interestingly enough, one of our opportunities right now, the US market has fallen a lot, but emerging markets have not. And so we're looking at that as an opportunity. It could be the US market as a buying opportunity, but we're watching that relationship to see if that's an opportunity to jump in on a rebalancing trade. Look for opportunities for tax loss harvesting. We don't expect you to do that either. We're also doing that, but as market declines, we sell things at losses and repurchase the similar assets for you so that you pocket the losses, but you get the growth in there afterwards. And then if you've got some securities that you feel like should be rebalanced, Now maybe they're too appreciated to rebalance them without a big tax implication. Well, when they decline a lot, it might be a good opportunity to sell those at a little bit less tax liability. So we're looking at those at opportunities. And then the bottom line is just buy when the market's lower. When the market is lower, that's the time to, become more aggressive in the portfolio, not to be fearful and run for the exits. And that's what we do. We look for the opportunities to rebalance into a less expensive market. We look for the opportunity to accelerate dollar cost averaging. We're tax loss harvesting and buying in when the markets are lower. And so that's really how you win in your investment portfolio, is just to be, not be like the herd, go the opposite way. And I know you've heard it 100 times, but, Warren Buffett always says that when the market is greedy, he is fearful, but whenever the market is fearful, he's greedy. And we feel the same way. When the market's running for the exits, we're running for the door, because we want to make sure that we pick up those securities at the best prices possible. And you don't get better prices than during periods of corrections when the rest of the market's fearful. So we want to make sure that we take advantage of that. Okay, well, I'm past my time already. I want to thank you very much for the opportunity to help you. I know everybody here is just grateful for the chance to spend time with you and to help you with your planning. I hope this has been a little bit reassuring. I would throw in one final thing I meant to tell you, is that one question that comes up occasionally is how much exposure we have to Russia. And you'll be comforted to know that our investment portfolio, even in our emerging market position, has less than 30% of the index exposure to Russia. So even in our EM exposure, our emerging markets, we have less than 1% of our EM exposure is in Russia. So it's a very, very small percentage, and 70% less than the index. So nothing to be concerned about on that front as well. Meant to throw that in, but I thought you might appreciate that. So I hope this has been reassuring. We're always here if you need to talk about it further, if there's something specific in your plan that you would like to discuss. But mostly I want to thank you for putting your trust in us to manage through this, this volatility and to know what to do. And if you have any questions or need anything at all, don't hesitate to reach out. We'd be happy to talk with you.